Joining our closing bell exchange today, David Bailin, Chief Investment Officer from Citi Private Bank, and Rick Santelli from the CME in Chicago. Very good afternoon to you both. David, if I start with you, when you add to the fact that Sarah just said up 20% from the lows, that we've got incredibly low VIX and volatility, is there a sense of complacency out there at the moment?
I think a bit of complacency. You know, we've come full circle, as you said, since what happened in December. But what markets are not anticipating is the fact that growth is, in fact, slowing somewhat. And we're having a benign interest rate environment. We're anticipating no future Fed hikes. So people are assuming the best possible outcome. But that's probably more growth than is actually possible for the S&P.
Rick, everybody's talking about the 10-year yield breaking below 260, new lows for the year. Is that an ominous signal about growth?
3 or 4 more basis points added on to that, and I would say yes, a resounding yes. If we take out this kind of 255 area that is the low for the year from the 3rd of January, and then we flash back all the way to January of 18, there's a certain level of nervousness about falling interest rates, even though obviously conventional wisdom is, oh my God, do I really want to be long stocks if rates are going up? That was the refrain in January of 18, but this is something to be concerned about. You know, with all the central bank issues going on, and with our Fed still with a fairly decent stockpile of its own treasuries, it's hard to divine where the pressure is coming from. Is this just the relative value trade with Europe and Japan's rates so low? Is the Treasury market telling us more? Are we failing to listen? I think lower yields, especially if they crack some of these significant levels we're getting close to, is going to end up being a bad fundamental for stocks. And personally, I think we're, you know, in that perfect period. I don't know if it's Goldilocks, but I think the central bank here sees straight in terms of how to deal with inflation that isn't getting too hot, wages and productivity that are maybe more in balance. So it is something to pay attention to. And my guess is, especially if this go around, we don't get closer to the contract highs, as Bob Pisani's been saying, and we fail at the top of the equity range. If while that's occurring and trade is unresolved and rates get below those key levels, I can't imagine we're not going to get some kind of response in the equity market.